The top business stories live from the Sky News City studio. UK manufacturing faces 2 years of anaemic growth, according to a new survey of the sector. More evidence of a housing market revival as asking prices see their biggest rise in 10 months. Plus, a boost for Currys amidst the takeover talk as it reports stronger than expected sales. Good morning, this is Business Live with me, Ian King. UK manufacturing faces 2 years of anaemic growth, according to a survey published this morning. The latest quarterly manufacturing outlook survey from the industry body Make UK and the business advisory firm BDO suggests output this year will remain flat, with weak growth expected next year. However, despite this, confidence levels among companies remains high. Well, joining me now to talk about this is Fhaheen Khan, the senior economist at Make UK. Welcome to you. What are the factors weighing on growth just now?
Good morning, Ian. So it's been interesting from what we've seen from our survey results. Manufacturing has not been doing well. We saw some early signs of a slowdown actually towards the middle of last year, where order books were declining in light of rising interest rates, which has begun to restrict the economy. And we've seen a massive slowdown in expectations that suggest that manufacturers are predicting that there's going to be a weak growth, but not this year, but also in 2025. And we expect the UK industry to fall behind the wider UK GDP growth over the next 2 years. There are several factors to that, but the domestic economy slowdown is perhaps the biggest reason of that.
Yeah, I mean, the last couple of months we've also had a lot of incidents in the Red Sea affecting shipping and delaying the delivery of goods and components and so forth. Is that a factor?
The Red Sea was not welcome news for the manufacturing sector. However, across our membership, we haven't seen the impact being as bad as we might have predicted it might have been a few months ago. Part of the reason is it's actually not the first time businesses have been dealing with supply chain issues from that part of the region. You might remember something around the Suez Canal when the boat turned sideways and blocked shipping routes for several days. What has changed since then is that we've seen manufacturers reformulate their own crisis management within their own firms, which made them better adapted to deal with such situations. We have seen lead times increase about 2 to 3 weeks on average for most businesses, but that's been manageable over the last couple of months. So it's not the biggest factor, but it's not the brightest news for them either.
Yeah. What about sterling? I mean, sterling was the second best performer of the G10 major global currencies last year. Is that weighing on export growth?
Well, the sterling is interesting because most manufacturers in the UK sit within the middle of the supply chain, so they don't just export goods, they also import goods. So when the sterling improves, it does negatively impact our exports, but actually it improves our ability to import goods from overseas, from the EU, from the US, which is our major markets. And actually, without access to that, we would certainly see a bigger decline. So whilst the sterling is a factor, its net effect is generally balanced out by the fact that imports also become cheaper when the sterling improves. So that's often a good thing.
Yeah. I mean, despite this fairly gloomy outlook, you say optimism among businesses is quite high. Why do you think that is?
You know, it's very interesting to see, despite all the turbulence that manufacturers have faced recently, their confidence and their optimism seems almost unshaken by slowing demand, by rising interest rates. We see that as perhaps a reflection of the growing resilience in manufacturers, that the situations that they have been firefighting over the last 5 years have been so shocking that manufacturers don't see a small or a slight decline in activity as being a huge problem because they faced much worse before. That does suggest that you might get a little bit of overconfidence in the industry, and so we do need to be careful. But we would commend that certain recent policy changes, such as making full expensing capital allowances permanent, has been positively received by manufacturers, and we are seeing investment intentions rise. So businesses are looking to expand capacity in the hopes that demand will return in the future, and they believe it will, despite the growth forecast and what they show.
That's good news. I mean, I guess also inflation is coming down. We're expecting cuts in interest rates later this year. I mean, all of that has to be positive for sentiment.
Yeah, I think from the perspective of inflation, we have seen perhaps the end of rising interest rates and the Bank of England's intentions to control inflation, growing inflation, seems to be working. And so from the perspective of consumers, that is good news. However, in our own survey results, we have seen manufacturers actually raising prices just a little bit at the start of this year, which suggests that actually costs may be increasing again for some businesses, which could result in a potential concern for rate setters over the next couple of months. So I think it's difficult to say whether or not interest rates will be frozen this year, or if anything, would they be cut? We cannot say at this point.
OK, Fhaheen, we've got to leave it there. Good to see you this morning. Thank you.
Very much.
Some other business news stories for you now. And Currys said this morning that since the 6th of January, its sales have been stronger than expected. The UK's biggest electrical goods retailer said that, as a result, profits for the year would be at least £115 million. It had previously indicated they would come in at between £105 to £115 million. Well, the news comes days after the Chinese e-commerce giant JD.com and the US investor Elliott said they would not be pursuing takeover bids for Currys. Shares of Currys have risen by more than 4% this morning. The UK's biggest supplier of paving slabs, curbstones and protective street furniture said this morning that it blamed weakness in the house building and construction sectors for a drop in profits. Marshalls, which also owns the roofing tiles supplier Marley, reported a pre-tax profit of £22.2 million for 2023. That was down 40% on the previous 12 months. Marshalls admitted sales in the first 2 months of the year were lower than in 2023 and warned that activity levels would remain subdued in the first half of the year. The shares are currently off some 7%. The insurance giant Aviva has raised £937 million after completing the sale of its 25.9% stake in Singapore Life Holdings. The sale to Japan's Sumitomo Life was first announced in September last year and also included the sale of 2 debt instruments. Aviva had held the stake since selling its majority stake in Aviva Singapore to a consortium led by Sing Life in 2020. The sale means Aviva has brought in some £8 billion from disposals during the last 3 years. And the trial of one of Britain's most famous tech entrepreneurs begins today in San Francisco. Mike Lynch is accused of inflating the sales of Autonomy, the former FTSE 100 software company he founded prior to its £7 billion sale to Hewlett-Packard 13 years ago. Around a year after the deal, Hewlett-Packard wrote down the value of Autonomy by more than half. Well, Dr. Lynch has said he has been scapegoated for Hewlett-Packard's mismanagement of the business, but a lot of the evidence he hoped to bring to that effect has been deemed inadmissible by the judge. Well, the oil price today hit its highest level since the 6th of November last year, amid news of successful Ukrainian attacks on Russian refining capacity over the weekend. A barrel of Brent crude is currently changing hands at $85.71 a barrel. That's up a little under 0.5% on the session. On the equity markets, following Friday's lacklustre session on Wall Street, during which the S&P 500 notched up a second consecutive weekly loss, stocks in the Asia-Pacific region had a positive session overnight, as you can see. Sentiment was buoyed by news of a rise in Chinese industrial output in both January and February. Well, in Europe this morning, stocks have been trading largely to the upside. There you go, they're all in positive territory right now. Talking points today include Logitech, the Swiss maker of consumer computer keyboards and mice. Is that mouses or mice? Is down 8.5% in Zurich after the unexpected departure of its chief financial officer. Well, here in London, the FTSE 100 is also in positive territory right now. It's currently up just over 0.25% higher, helped by the oil majors, as you might imagine. In percentage terms, the Lloyds insurer Beazley is among leading gainers. You'll recall that we had the chief executive on the programme recently talking about the company's latest results, which have attracted some positive broker comment this morning. Beazley 2.25% nearly to the good. Also up this morning, Reckitt Benckiser, that's rallied very slightly after Friday's monumental sell-off. It fell by a fifth of 1% at one point. Among the fallers this morning, as you can see on the screen there, Phoenix Group, the insurer, off by just over 4.25%. That's on weekend press comment. Meanwhile, the consumer goods group Haleon has fallen by 4.75%. That is on news that the US drugs giant Pfizer is planning to cut its stake from 32% to 24%. Outside the FTSE, Bytes Technology is down some 12%. That's after the IT services group appointed a committee to investigate the resignation of its former chief executive. On the foreign exchange markets, it's all fairly quiet right now. As you can see there, big week this week coming up for central bank decisions. Well, joining me this morning, our old friend Russ Mould. He's the investment director, of course, at AJ Bell. Russ, good to see you this morning. Lots going on. Start with Currys, shouldn't we, really?
Well, I think we do this every week, don't we? Talk about it feels like it at the moment. Yeah, but profits 4% better than expected for the full year. Alex Baldock, the boss, saying that the UK and Nordic markets, stronger sales than expected and better margins. And the sale of the Greek business is on track for April, which will help the company further shore up a already pretty reasonable balance sheet. shares up. I guess the test for Mr. Baldock now is that the shares are up by a fifth from when Elliott first had a nose around, but they're below the first Elliott bid, let alone the second Elliott bid. So his long-term goal will be to shareholders, you did the right thing, you gave us the chance, now we'll prove we can get the share price over and above what Elliott were prepared to offer, which was 62 and then 67 pence a share.
Yes, that's right. I mean, looking at the statement in detail, though, I mean, it's quite encouraging. They're talking about a rise in like-for-likes, and they were up against some relatively strong comparatives.
Yeah, and the Nordics markets have been through a particularly torrid time. Competition there has been absolutely brutal. But again, it is intriguing the UK showing some positive like-for-like growth. Maybe that's the benefit of that big physical footprint that it has that nobody else has got for white goods and electricals anymore, which maybe is one of the reasons why Elliott was looking in the first place.
Yeah, no, elsewhere today we heard from Marshalls. Not terribly good news.
Yeah, that's not quite so good. I guess that's down to weakness in the residential housing market that we're very familiar with. We've seen all the completion figures from the big house builders are all down year on year in 2023. I guess of greater concern is the statement for the early stages of 2024. January, February, down year on year. First half weaker than expected. Management's already got the prayer mat out for a second half recovery, which is never a great thing so early in the year. So the shares are down 7%. I mean, they're up 50% from their lows, which is no bad thing, but they're way off from their highs of 3 or 4 years ago when the home improvement boom was at its peak.
Yeah, I mean, the thing that would worry me about this, Russ, as you say, sales off for the first couple of months of this year, whereas we just had GDP data suggesting that construction did reasonably well in the first.
Yeah, I guess that's a one-month number, and these things can swing around an awful lot, so I'd probably be paying more attention to the companies than I would be to the statistics, if the truth be told.
Yeah, now elsewhere, BAT caught your eye. Some comments there in the FT.
Yeah, I mean, there was this story about, first of all, the buyback that the company's announcing. It's selling $3 or $4 billion stake in one of its Indian subsidiary, or an Indian business that it's had a stake in for a very, very long time. But it's going to put that money to good use, or as far as it's concerned, to good use through share buybacks. That's solving an issue that it's had with a few shareholders who were unhappy with last year's absence of share buybacks. Boss today in Morocco has also taken the chance to say, we're not moving to the New York Stock Exchange. Thank you very much. The people pressuring us for it. We don't think that's the slam dunk that people think it is. It's a distraction for the business. And it's nice to hear a boss talk about managing the assets of the business and not just managing the share price.
Yeah, absolutely. I mean, Neil Collins used to come on this programme a lot as a pay-per-view. He always used to make the point that at the rate it was going, BAT would be able to buy back all of its shares within a decade.
Well, I guess there's an ethical consideration here, whether you approve of what the company does, and I know it's trying to change that through vaping, which the government's now taxing heavily as well. But in terms of it still being a wildly profitable business that generates a lot of cash and has this big asset in India that it can... I mean, yeah, ITC is a $63 billion market cap company. So there's a lot of money that it can raise there over time if it sees fit. So, yeah, it probably could, in the end, literally buy itself out if it wished to.
Astonishing business. A quick word on Fhaheen.
Yeah, I guess the challenge there is the shares did well after the initial flotation. You know, this is the, sort of Advil business and consumer health and vitamins and minerals. But the shares have been flat for 15 months. GSK has been selling its stake down. Pfizer's been selling its stake down. If you want some of them, there's probably no shortage of them, I guess, as far as the shares is concerned. And that's the challenge for the share price in the short term. But the business seems to be performing perfectly solidly.
Yeah, very good team there, Brian McNamara has got. Yeah, Russ, good to see you as ever.
Thank you.
Now, there's further evidence this morning of a revival in the housing market after RightMove reported that the average price of newly marketed properties grew this month at its fastest pace for 10 months. The property portal said the average asking price had risen by 1.5% this month, compared with the historic March average increase of 1%. RightMove also said it had seen an increase in buyer demand, measured by people sending inquiries to estate agents, along with stronger sales numbers than a year ago. Well, joining me to talk about this now is Tim Bannister. He's RightMove's director of property science. Tim, good to see you this morning. March is traditionally quite a strong month. Do you think there's more than just seasonal factors at play here?
Yeah, good morning, Ian. Yeah, so it does seem that it's a little bit more than seasonal factors. You know, normally we'd see about a 1% increase. It's been about 1.5% increase in those new seller asking prices. Demand is up a little bit better than it was this time last year. It's up 8%. And actually critically sold subject to contract, so transactions, finding a buyer, they're also up a good amount on last year, around sort of 12% or so. So some indications that there was positivity at the beginning of the year. You know, we saw a really strong Boxing Day. We saw the launch of lots of properties, a record number of properties coming to market, and demand was strong at that point. And it has continued in the early part of this year and seems to be sort of continuing into the early part of the spring selling season.
Tim, it does feel like it's a bit of a two-speed market, though. I mean, most of the action seems to be at the top end of the market. It's fairly becalmed at the first-time buyer end, it seems.
Yeah, so it does look like those the top of the ladder, sort of those detached houses or 4-bedroom detached houses and more, 5 bedrooms and more. Those are the ones where we've seen the biggest sort of jump. We're seeing the biggest jump in terms of demand there as well, and in those transactions. So yes, I think some of those larger properties where perhaps they're a little bit less exposed to mortgage rates, they have a bit more equity in their home, and that's where we're seeing a little bit more of the activity at the moment. I suppose it's worth bearing in mind, they had moved significantly during the pandemic, but then had come off a little bit. There wasn't much stock around through the latter parts of 2022 and into early parts of 2023. So we've seen a little bit more stock coming onto the market, and I think that choice is really important, because that's what drives people. People in that segment tend to be moving from one home to another. So if there is stock available, that's going to encourage them to want to move. So we're seeing, I think, that play out here as well.
Are year-on-year comparisons particularly helpful here, Tim, given the subdued start to last year?
Yeah, I think it's always needed to bear that in mind. Given last year we were on the coming out of that sort of mini budget. I suppose it had been quite a few months after the mini budget. But you're absolutely right. Often we look back to 2019 as well. So, for example, stock levels are now sort of heading back towards 2019 levels. So we're still not quite at those 2019 levels. Demand is stronger than 2019. So we are comparing back towards a sort of a more normal market as well. Things are looking reasonably positive. But I think, as you say, we have to be cautious. We are seeing that this two-speed market that you mentioned there is taking 71 days to find a buyer. If we look back last year, it was 57 days. So I think we're definitely urging caution at this point around, if you are coming to market as a seller, you've got to price competitively. It's still a price-sensitive market. We're still very much feeling the effects of a cost of living squeeze. So I think sellers really need to bear that in mind. Whilst there are some positive signs, we've seen stabilization in mortgage rates, for example, certainly compared to where they were in the middle part of last year, and that's being reflected in the demand levels. I think caution and competitive pricing is still really key for those who want to sell.
Very interesting there that you mentioned how long it's taking to sell a house. I think I'll find a buyer, the longest it's been at this time of the year for 5 years. Is that because buyers are still driving a hard bargain?
Yeah, I think we've seen a little bit of both. I think there's a bit of that optimism. So perhaps people need to just temper that optimism a little bit for when they're putting their properties on the market. So those new seller asking prices. We are seeing, certainly throughout 2023, we saw the level of price reductions increasing, and they were heading back from very low levels to sort of more normal levels. So up to about 35% of properties we see on the market were having to be reduced, and that's quite a normal number. That's where it was back in 2019. And that does reflect what you're saying there, I think, what was happening throughout 2023. Interestingly, that proportion of properties getting reduced is actually starting to reduce itself a little. So heading back now down towards a little bit lower than we were at the beginning part of last year. So yes, perhaps what we're seeing at the moment is that testing of that more equilibrium in the market, around price, around levels of reductions, a bit more normal levels of reductions, and the fact that buyers are negotiating hard with sellers, and sellers are also perhaps thinking twice about whether they want to accept those negotiations.
OK, Tim, got to leave it there. Good to talk to you this morning. Thank you.
Thanks, Tim.
Still to come here on Business Live, a big rise in profits at Team Internet. I'll be speaking next to the Chief Executive. Stay with us.
I'm Neville Lazarus, and I'm Sky's reporter based in Delhi.
I'm David Blevins, and I'm Sky's senior Ireland correspondent. Politically, the two sides are as far apart as ever, and it's over that question of who has sovereignty in Northern Ireland, the very issue that's been the source of tension here for generations. I've spent 25 years reporting the journey from conflict to peace.
The political parties of Northern Ireland have reached agreement.
We already know what the government gets out of this deal. What exactly does the DUP get out of it? Well, £1.5 billion. If there's anyone who might know how to fix Northern Ireland's devolved government, it's the American architect.
Changes in circumstance require changes in approach.
If we both contract COVID-19 and end up in hospital, religion's nothing.
If there's a hard border, I think it'll cripple the country.
You want to talk business? Meet me in the On-Board Lounge. Fly Emirates, fly better.
Welcome back. Now, last year saw Central Nick, an internet services company, change its name to Team Internet, taking its name from a marketing business it had acquired back in 2019. The name change was aimed at underlining how it had evolved from services like registering internet domain names to a broader digital marketing technology platform business. Well, today the company reported a pre-tax profit of $29.3 million for 2023. That was nearly twice as much as 2022. Well, joining me now to talk about this is the Chief Executive, Michael Riedl, who joins me from Luxembourg. Michael, good to see you this morning. You now have two main divisions, digital advertising being the larger. What was driving growth there?
Right. So in digital advertising, we are exploiting three mega trends, which are A, the ascendance of social media, secondly, the advent of data privacy, and third, we unlock this potential through our risk transformation model.
Impact is privacy law having on this?
Yes. So today, as you know, most people have an account on TikTok, on Facebook, Instagram, or any other social media platform. And data privacy has made it very challenging to target customers on these platforms. And what we do here is we very skillfully acquire customers on these platforms, run them through our portfolio of roughly 300,000 micro websites, where we then match them with the most fitting search ad campaigns that other people have booked on Google or other search engines, and thereby basically overcome the challenge of targeting users on social media and making a profit in the process.
And typically where you're engaged in this sort of work, would a client hire you on a sort of campaign by campaign basis, or do they sort of lock in for a longer period with you?
Well, we can basically tap the entire network of advertisers who are advertising on search engines, and our AI would at any point in time, on the fly, decide which user should be matched with which ad campaign that runs on any of these platforms, which opens us up to millions of advertisers. So we always consider the internet user as our customer, because we need to make the internet user happy, so that they engage with our consumer journey, and whoever is the best merchant for them, we match it up with the user.
Now, one thing I thought you did last year that was quite interesting was that you engaged the services of a futurist. What sort of insights are you hoping to glean from that?
Well, at Team Internet, AI has always been in the fabric of our daily operations, mostly in the form of machine learning. But with this futurist, we've now come up with a major program to simultaneously enhance efficiency, augment our products, and explore new models that before the advent of AI were inconceivable, which, for example, includes products like our ad format Absolutely, which is an ad that automatically learns in which kind of content it has been placed and automizes itself around the content in which it sits, or a fully automated website autopilot that always keeps the website up to date, reading news feeds and constantly writing new articles to always be up to date.
OK, and looking at the other part of the business, your traditional business, domain name solutions, what's been going on there? I noticed there was a very interesting line in the statement where you say that domain names are becoming more exotic. What do you mean by that?
Right. So the general raison d'etre for our business model is basically being a clearinghouse in this industry, where you have 4,000 different companies selling domain names to the general public, and offering a choice of 1,500 top-level domains like com, net, org, uk.de, you name it, which would give you 6 million combinations. And we reduce this. This is the first mega trend that we are playing. This model is most relevant when it comes to country code top-level domains and other exotic, what we call repurposed domain names. Today, companies more and more often choose to take their local top-level domain, like a .uk or a .de or .ch, you name it. But at the same time, there's also a mega trend towards exotic domain names like .ai, which is for the island of Agia, but which is now repurposed for artificial intelligence, or .io, the British Indian Ocean territories, which is very hip among digital companies, resembling 1 and 0, or .co for Colombia, resembling a hip alternative to .com. And that's what we call exotic domain names, and this is exactly
very good. Michael, we have to leave it there, I'm afraid. Thank you very much for your time today. Thank you. That's it from me. I'll be back at 4:30 this afternoon. See you then. Up next, it's Jane Secker. Cheerio.